Hello all, welcome to Paritranaya. In this class, we shall discuss about another very important economics related topic, that is assets and liabilities of a commercial bank. So often in our initial stages of preparation, we come across this word called as scheduled commercial bank. So we get confused. So what are these scheduled commercial banks and what are the other banks? So initially you need not focus on the deeper aspects of what exactly are scheduled commercial banks. In the forthcoming classes, we'll be discussing about them in detail. But at a superficial level, we shall understand that so scheduled commercial banks can be both private banks as well as government sector banks. For example, if I take SBI, so SBI is a scheduled commercial bank and it's a government bank, that is public sector bank. Similarly, if I take ICICI as an example, it's a private sector bank and also a scheduled commercial bank. So we understood that a scheduled commercial bank can be both private bank as well as public sector bank. But here what we are interested in knowing the assets and liabilities of a commercial bank. So often in the newspaper while reading we come across these assets and liabilities, and also from UPSC especially prelims point of view, so often they focus on these assets and liabilities. So from that perspective, what it is important for us to understand, so what are the assets and what are the liabilities. So at a superficial level we shall first understand that every commercial bank has some parts assets, okay, and liabilities. So what are liabilities? Liabilities are the things which the bank is bound to pay anytime in the future. It has to return back the amount. So an example of asset can be land. So land is an example of an asset. Similarly, the building which is owned by a bank. So all these, they form part of assets. But these are just examples. We will be discussing in detail what are the various parts which are known as assets. Similarly, when it comes to liabilities, so I have taken an example wherein whatever the deposits the people make in the bank, so these deposits, they are nothing but they are liabilities, because next time when the people who have deposited the amount, they come to bank to withdraw it, then bank is bound to pay them back. So that's why it is a liability. So the deposits which the people have made in the bank, it forms part of the liability. Okay, liability. Next we shall see which are the different components of assets, or what are the various assets which the bank owns. So first one is cash in hand. Cash in hand. So what is it? Cash in hand? Whose hand? So cash in the hands of bank. Cash in the hands of bank. Now whatever the deposit the people make in the bank, so all the deposit will not be retained by the bank itself. So some of the amount it will lend it to others. It will give as in the form of loan to others. And at any point of time, so I have taken SBI as an example. At any point of time, when we go to SBI bank or any other bank and open its locker, so whatever the total amount is available in the form of a cash, so that we call it as what? Cash in hand. Cash in the hands of banks. So here let us assume in SBI lockers, if there is 1 crore rupees, then we say how much cash in hand is present in SBI's bank? 1 crore. Okay, it is 1 crore. Next, balances with RBI. Okay, balances with RBI. Now there are various balances which a bank maintains with the RBI. Okay, various balances which the RBI bank maintains with the RBI. So which are those balances and why it has to maintain? All those things we'll be discussing in the forthcoming classes when we start discussing about what monetary policy and other things are and all. But here we shall understand that some amount a bank, so in this example SBI maintains with RBI. It means let us assume RBI has deposited some 10 lakh rupees in RBI. SBI has deposited 10 lakh rupees in RBI. So why? So that we shall discuss later on. But that 10 lakh rupees, so again it's an asset of commercial bank, because in the future when SBI demands to RBI to return back the amount, so RBI should return back the amount. So that's why it forms part of the what? Asset of a commercial bank. Next, balances with banks in India. Balances with banks in India. Now, let us consider this scenario. A person of ICICI Bank, so he holds an ICICI Bank's ATM card, but he comes and withdraws the money from SBI's ATM. So it means ICICI customer has withdrawn the money from SBI's ATM. Now who is supposed to pay the money to whom? ICICI Bank should pay money to SBI because its customer has taken the amount from SBI's ATM. So before these adjustments are made, so some amount of SBI is stuck with ICICI. Okay, so these are the example of balances. So balances with banks in India. So this is just an example. Similarly, SBI can have balances with banks outside India. Okay, banks outside India as well. So it can have balances with some foreign bank. Okay, foreign bank. So here I have taken SBI as an example. The same extends to every other bank as well. It may be Canara Bank, or it may be Corporation Bank, or it may be ICICI Bank, every other bank. Okay. Next, money at call and short notice. So a very important point here, but we'll be discussing in detail when we start discussing about money markets. Okay. We'll start discussing about a concept called as money market. So here at a superficial level, we shall understand that. So banks are short of money for a temporary period. Okay, for a temporary period. So let us consider an example of HDFC Bank. So let us assume HDFC Bank is short of money. It requires money for either 1 day or for 14 days. So if it requires money for just 1 day, then it can borrow the money from a market. We call it as what? Money market or call money market. So if it requires money for only 1 day, it will borrow the money from call money market. And if it requires money for more than 1 day, but for up to 14 days, then it can borrow the money from notice money market. Okay, notice money market. So again, in detail, we will be discussing later on. But at a superficial level, we shall understand that whenever any banks require money for a very shorter period of time, then at that time, they can take that money from money market. Okay, money market. So here, in the money market, let us assume SBI has given money to HDFC. Okay, SBI has given money to HDFC. So this money, after 1 day or after 14 days, it will come back to SBI. So whatever the money the SBI has given to HDFC as part of what? Money at call and short notice. So again, they are assets of SBI. They are assets of commercial bank. So again, very important point to note. Okay, even if you are unable to connect all the dots over here, just understand that money at call and short notice, it is part of the asset of a commercial bank and it is not part of the liability. Because often in order to confuse us, so UPSC might frame the options in such a way that it will say, so money at call and short notice, it is part of the liabilities of a commercial bank. False. It's a part of the asset. Similarly, they will say, so balances with RBI is part of the liability. No, it's part of the asset. So in this fashion, we should retain the information. Next, advances. Now, SBI will lend loan to others. SBI will lend loan to others. Let us assume it has lent some 1 lakh rupees to someone. So those loans which the SBI has lent, it comes under what? Advances. Okay, advances. So here within advances, type wise, security wise and sector wise, I have mentioned here. So these are not important. So why I have mentioned them and indicating that they are not important? Because often when you come across multiple sources, you get confused whether the content which I have, whether it is sufficient for the examination or not. So in my content, this information is missing. So probably while discussion, sir might have missed it out. No, that is not the case. That's why deliberately I added it. So this content is not important from exam point of view. So maximum the UPSC will focus is whether advances form part of the assets or part of the liabilities. So we need to understand that advances form part of the assets of the commercial bank. Similarly here, investments. So when it comes to banks, they also do make investments. For example, here a bank has made an investment in a treasury bill. So already we have seen what is a treasury bill. So whenever government wants funding or wants to raise money, it will pay treasury bills and it will sell in the market. And those treasury bills can be brought by SBI. So whenever SBI invests in the treasury bill, obviously afterwards SBI will get back the amount. So that is why the investment is considered as part of the what? Asset of the commercial bank. Similarly, if SBI purchases shares of Infosys, so that is also what? Those shares are that they are assets of commercial bank, assets of SBI, because later on when SBI sells the shares of Infosys, it will get back the money. So even investments that have been made, they are part of assets of a commercial bank, assets of commercial bank. Next, finally, fixed assets. So as I mentioned, fixed assets may be land or it may be what? Some building and all. So all they are part of the fixed assets. Okay, fixed assets. So this was about assets. Next, we'll discuss about liabilities. Now, here we come across capital and reserves. So in detail, we'll be discussing later on. So what are these capitals and reserves? But here at a superficial level, you understand that whenever I say capital and reserves, so whether they are part of the assets or liabilities, they are part of the liabilities. Okay, they are part of the liabilities. Next, borrowings. So for example, if I take SBI, it will take loan from some other bank or some other financial institution. So when it has taken loan, obviously it has to repay it. So borrowings that the SBI has made, so again it comes under liabilities because it has to be paid back. Okay, it has to be paid back. Now important is deposits. So again deposits are part of the liabilities. Why deposits are liabilities? Because deposits are paid by the some customer or an individual or any other institution. So whenever you receive funds, obviously automatically you have to return them back. So that's why they are liabilities. But when it comes to deposits, there are again it has been classified. The deposits, these liabilities have been classified into two types: time liabilities and demand liabilities. So what is demand liability? When you go to a bank, if you have deposited amount in the bank and you go to a bank and you ask them to return your money, so if they are binded to return them back immediately, return the amount immediately, then such deposits, we call it as what? Demand liabilities. And example of a demand liability is savings account. So majority of us, we have savings account in the banks. So whenever we want money, we'll either go to ATM and withdraw it, or through check, we'll withdraw the amount from the bank. And bank cannot deny. Okay, always it should give back our money whenever we demand it. So such kind of money, such kind of deposits, we call them as what? Demand liabilities on part of the bank, because bank has to give back the money on demand whenever we demand it. But another example wherein banks can deny you your deposits. It may say that, for example, fixed deposit. Now you have deposited, let us assume in the month of January, and of a fixed deposit, and its maturity will be for 1 year. Means after 1 year itself you can withdraw, and there will be a rate of interest which will be provided by the bank. So after 3 to 4 months, so if you are shortage of money and if you demand in the bank saying that return back my amount, then bank may refuse to give you. Bank may refuse to give you. They'll say, no, its maturity period is 1 year. So you come in the next year, January, so we'll give you back the money. So such kind of deposits which you have made, wherein a bank is not bound to give the amount immediately. So such kind of deposits are called as time liabilities, and the best example is fixed deposit. Best example is fixed deposit. Apart from the fixed deposits, which are the other examples? We are all aware of what? Recurring deposits. Okay. So in fixed deposits, initially a lump sum amount is deposited, whereas in recurring deposit, every month you will start depositing the amount. Okay, amount. Here also you cannot withdraw at any time. Only after the maturity period itself you can withdraw. So in this case also, if you go and make demand in the bank to return back the amount, they'll not give you. Okay, they'll ask you to wait. Even if they give you, even if they return the funds, they'll return with a penalty. You have to pay penalty for it. Now similarly, cash certificates, you just assume that they are something similar to fixed deposit. Next, similarly, staff security deposit also, they are something similar to cash certificates and fixed deposit. So here, at a superficial level, you understand that whenever they say staff security deposit, and they'll ask you a question whether it's a time liability or demand liability. So you should be able to identify that it is a time liability. If they give you current account and if they ask you whether it's a time liability or demand liability, it's a demand liability. So these current accounts, these are maintained by whom? So as savings account are maintained by common man, so current accounts are maintained by what? Business people. So those who own a business, so they require some extra features. So that's why they go for current account. So here we will not go into the details of what exactly is the difference between the current account and savings account. But here at the superficial level, you shall understand that the balances which are present in the current account, they are part of demand liability. So whenever the business person, he goes and demands in the bank for the money, so bank is bound to give the money. So current account forms part of demand liabilities. Similarly, we are aware of demand draft. So whenever we present a demand draft in the bank, so bank is bound to what? Pay the money. So demand draft, they are part of demand liabilities. Okay, demand liabilities. So often in the newspaper, we hear about this term. What is that? Net demand and time liabilities, which is also called as what? NDTL. So this is also very important. Net demand and time liabilities. That is total of the what? Demand and time liabilities. We call it as net demand and time liabilities. Now here we come across a term called as what? Demand draft more liquid than savings account. So important here. So which one is more liquid? We come across a word called as liquid. Liquid is anything which can be converted, into what? Cash immediately. So that is called as more liquid. Okay, more liquid. For example, if I take land and if I take gold, So which one is more liquid? Gold is more liquid, because gold immediately you can sell it in the market and you'll get the money. But land, yes, you can sell it, but it will take significant amount of time. So among gold and land, gold is more liquid. Similarly, when it comes to fixed deposits, and when it comes to savings account, so which one is more liquid? So when it comes to fixed deposit and savings account, obviously the savings account is more liquid, because the amount which is present in the savings account, you can withdraw it immediately, whereas the amount which is present in the fixed deposit, in the form of fixed deposits, you cannot withdraw it immediately. Okay, immediately. So here, from exam point of view, we need to remember notice that what kind of questions can be asked. So often they will make a statement like this. So cash certificates are part of demand liabilities or time liabilities. They are part of time liabilities. So in this fashion, we should be able to identify the things and mark the correct answers. So the things which we have discussed here, predominantly they are important from prelims point of view. So in the mains point of view, at the superficial level, we should be able to quote about the statistics, like what are the assets and what liabilities of the commercial banks, so whether they are performing good or not. Okay, only at the superficial level is required. But from the prelims point of view, so all these things are necessary, and we need to memorize these various components. Okay, so components which form part of the assets and the components which form part of the liabilities. Okay, so all these things are important from exam point of view. In this class, we discussed about assets and liabilities of the commercial bank. Similarly, in the forthcoming classes, we will be discussing about the other important topics related to economics. For all our further updates, subscribe to our channel and hit on the bell icon. Thank you.